Welcome back. In the previous video, we learned how business transactions are recorded using the double entry accounting system and organized in the general ledger. Now, let's take the next step in the accounting cycle, preparing accurate financial information that businesses use to measure performance and make informed decisions. Businesses can record financial transactions using one of two accounting methods, cash accounting or accrual accounting. Under cash accounting, revenue and expenses are recorded only when cash is actually received or paid. It's simple and commonly used by small businesses. Accrual accounting, on the other hand, records revenue when it's earned and expenses when they're incurred, regardless of when cash changes hands. For example, if a customer receives a product today but pays next month, accrual accounting records the sale today because that's when the business earned the revenue. This method provides a more complete and accurate picture of a company's financial performance. At the end of each accounting period, businesses prepare adjusting entries. These entries ensure that revenues and expenses are recognized in the correct accounting period and that financial records remain accurate. Common adjustments include recording depreciation on equipment, recognizing accrued expenses such as unpaid salaries, and allocating prepaid expenses like insurance over the period they benefit. Without these adjustments, financial statements may not accurately reflect the company's true financial position. After all adjusting entries have been recorded, accountants prepare an adjusted trial balance. This report lists the updated balances of every account after adjustments have been made. Its primary purpose is to verify that total debits still equal total credits, confirming that the accounting records remain balanced before financial statements are prepared. The adjusted trial balance serves as the final checkpoint in the accounting cycle. With the adjusted trial balance complete, the business is ready to prepare its financial statements. The income statement summarizes revenue and expenses to determine whether the business earned a profit or incurred a loss during the accounting period. The balance sheet provides a snapshot of what the business owns, what it owes, and the owner's equity at a specific point in time. The cash flow statement explains how cash moved into and out of the business through operating, investing, and financing activities. Together, these three reports give business owners, investors, and other stakeholders a complete view of the company's financial health. We've now seen how accounting information moves from recorded transactions to meaningful financial statements. In the final video, we'll learn how to interpret these reports, explore key financial metrics, and understand how businesses use this information to make smarter financial decisions.